G'day fools, and welcome to a very special Motley Fool video where we're taking a deep dive into what is probably the hottest sector on the ASX right now, known by the acronym BNPL, or by the rest of us as Buy Now, Pay Later, or maybe, if you've been around for a while, Laybuy on steroids. That's right, Buy Now, Pay Later has been enormous in terms of its impact on the ASX, and it's another kind of nice Australian export that we're taking to the rest of the world. Over the next little bit of time, I'm going to be catching up with three of the Motley Fool's gun analysts to talk about the buy now, pay later sector, to give you a sense of what it is, who the players are, what you should know about these companies, and maybe, if I can twist the guy's arms, we might get a couple of stock recommendations towards the end. So you want to make sure you stay here for this whole time because, as I said, this is going to be a sector that remains at the forefront of the ASX, remains both a talking point and a potentially profitable, potentially lucrative area for you to invest in, but you've got to know what you're doing. You've got to know the companies you should be looking at, and as importantly, the ones you probably should give a wide berth to, at least until a bit more pans out. All right, without further ado, let me introduce to you Ryan Newman, Kevin Gandiya, and Chris Copley. Gentlemen, thank you for joining us for this important video and a bit of time together. Let's kick off with you, Chris. Just give me a quick Cook's tour. Give me a quick sizzle reel. What is going on in the buy now, pay later space right now?
Yeah, well, I guess with the Olympics on right now, we know that we Aussies love a local success story, and I guess buy now, pay later is it's certainly one of them. So, we've really been in Australia. We've had the innovators and the leaders in the space, and it's also quite exciting because as investors, we can look back at some of the returns these businesses have been able to deliver over the past several years, and it really is incredible. So, Afterpay, for example, has increased from, it was just a couple of dollars per share several years back, and now it's well above 100 per share. Zip's also delivered massive returns for investors, and there was one point where Sezzle was trading for 35 cents per share during the height of the pandemic last year as well, and it's now at around $8 per share as well.
Wow, okay.
So yeah, there's been some incredible, I guess, life-changing returns that has been delivered from this sector. But yeah, the landscape for this industry has changed a lot in recent years, though, and even more in recent weeks and recent days. So I guess there are a number of buy now, pay later businesses on the ASX alone. So that does tend to happen in massive and rapidly growing industries because it attracts competition, and it has certainly happened with the buy now, pay later space. So we'll be discussing, I guess, some of these businesses in further details later on. But just to name some of the ASX companies out there, there's Zip, there's Sezzle, there's Openpay, IOU Pay, Dough, Humm, and the list goes on. There's plenty. So the sector has been on fire, I guess, in the last week since there was an announcement that Square, a big US tech company, will be acquiring Afterpay, and we've seen share prices jump across the board in the sector. But between the announcement and the 3rd of August, we saw Openpay and SplitIt jump over 10%. Zip and Laybuy were up around 20%. IOU Pay was up around 40%. And of course, Afterpay saw its shares jump around 30% as well. And part of the reason for this was that Square's offer further validates the buy now, pay later space. And not only this, but the move that PayPal and Apple have already entered the space as well also helps to validate that. And that happened late last year and also during the month. So I guess the acquisition announcement also brings in further hopes that a number of these smaller buy now, pay later offerings will also actually be looked at as potential acquisition targets down the track as well. But yeah, despite the excitement of the market in the last few days, there are definitely some risks to consider in this space, and we'll be talking about that a little bit down the track as well. But it's an exciting investment space, and it's great that it's come from Australia, and yeah, looking forward to chatting about it more.
Nice, Chris. You've absolutely set a beautiful stage for us to continue on with the rest of this conversation. Let me turn to you, Ryan. This is obviously, and Chris already alluded to it. We know that buy now, pay later had arrived. Firstly, the fact that Afterpay is getting so big, but not only big in terms of market cap, big in terms of geographic spread. Colonised Australia, starting and doing a pretty good job colonising America, creating rivals here and over there in this buy now, pay later space, completely creating a category, which has been impressive. And then, as Chris mentions, the entry or the potential entry of PayPal, and I own shares in PayPal, I should disclose up front, and Apple potentially into this space also further kind of cemented its arrival. And then there was Monday morning, and nothing talks like money, mate. What happened Monday morning?
Yeah, so look, it's been really dynamic, and as Chris sort of alluded to already, things have changed incredibly fast. So this sector really kicked off a few years ago, and it's sort of come along quite quickly since then, but really taken off in the past couple of weeks. And really what sparked that, I guess, was, first of all, PayPal announced that it would be releasing its own buy now, pay later product in Australia. It's already got one in America. There was also a strong rumor that Apple would also be releasing its own product at some point in the near future, partnering with Goldman Sachs in Australia. That sort of, I guess, got the market a little bit anxious about where Afterpay actually sits in the market, and other buy now, pay later providers as well. Then, as you said, came Monday morning with Square's news that Square would be looking to acquire Afterpay for a massive sum, $39 billion Australian dollars, that is, so $29 billion, which you have seen different figures thrown around.
$10 billion among friends.
The $29 billion is US, $39 billion is Australian. So it's a massive deal, and obviously a massive, I guess, development as well for the entire sector, and I guess the prospects as well of some of these other businesses that play in the area.
It's been a big one, mate. In fact, it's probably even worth more than $39 billion now, right? Because Square shares have gone up in the aftermath, which means if you're converting them, as is the case. Now, look, if you are watching this and you want a bit more information, we do have on our YouTube channel. You may be watching this on YouTube, or you may be watching this through one of our services. But if you're watching on YouTube or you're not, jump on the YouTube channel, search for Afterpay in the Motley Fool Australia channel. We've done a couple of videos on this. This group plus Trevor Machedzi got together to talk about the takeover, and then Ryan and I did a quick summary as a follow-up in terms of what it means for Afterpay shareholders. So if you want more information about that specifically, go and have a look. Now, I will date stamp this video. We're recording this on Thursday, the 5th of August. I do that for two reasons. The first is we already planned this video last week, and then Afterpay came and kind of spoiled the party, so we've got to push this back a bit. Secondly, of course, anything could happen from here on. So this is being recorded on Thursday, the 5th. We are long-term investors at the Motley Fool, so our investment views will likely not change in a hurry, but of course, circumstances themselves may change. So we're talking about what we know as at this point. Please bear that in mind if you're watching this much later than the beginning of August, maybe middle of August. Ryan, thank you for the summary. Kevin, maybe, I don't know who doesn't know what buy now, pay later is these days, but I imagine there might be a few of us who are yet to use it. In fact, I did my first buy now, pay later transaction only this week. It was with PayPal. I've already mentioned I own shares, but it was one of those too easy not to. I was using PayPal anyway, and they invited me to click the button and pay in full, so I decided to. But I must be about the only person in Australia that had an Afterpay account, just in case there's more than one of us. Would you just give us a quick run through of kind of what buy now, pay later is, and maybe as importantly, why we had Visa, we had MasterCard, we had Amex, we had FPOS, all these things already existed. So firstly, what is buy now, pay later? But then maybe even more importantly, why has Afterpay been able to kind of shake up the payments industry in such a fundamental way?
Yeah, Scott, welcome to the 21st century. You've actually made a buy now, pay later transaction. I'm so proud of you, Scott.
I finally arrived. You never know, mate. Eventually I'll catch up with the cool kids. It won't be anytime soon, though.
Yeah, Scott, you finally arrived. And look, the question is, I know it sounds like a basic question, but this is, what is buy now, pay later? This is the question that everyone is actually asking, including our own Australian regulators, because depending on how you define it, it has massive implications on everything from regulation and, is this really innovation? Is this technology or is this regular credit, or what exactly is it?
Right.
Look, let's start with the basics, right? So buy now, pay later. This is, I guess, a form of innovation or financial engineering that really allows consumers like you and me to go into a store, buy the product, get the whatever we're buying. If I'm buying a pair of sneakers, get the sneakers now. And instead of paying, if they cost $100 or $200, instead of paying that upfront now, maybe pay 4 installments of $50 each week, and then that's it. Now, the interesting bit here is there's no interest. There's no interest typically being charged to the consumer. We know credit cards do exist where you can swipe for things and pay it over time with interest. But in this case, typically there is no interest being charged to the consumer. What these companies are charging is they're actually charging the merchants, the companies that are selling the products. They are charging them a merchant fee, which is usually around anywhere between 4 and 6%, depending on the company. And it's interest free for the consumers who are buying the product. Now, there is usually a late fee that is charged if you're late, but as long as you're good and paying your installments on time, there is no interest. Now, the question is, why would it makes sense for the consumer, right? You can pay in installments and pay no interest, but why would the merchants agree to this? And the reason is, firstly, there's a whole new generation of consumers who are shifting away from the traditional way of buying. We know that in the payment space, these trends and shifts tend to happen over time. We started off with cash, we moved on to cards, and credit cards have become a thing. And then now there's a whole new generation, millennials, you may call them, I'm one of them. Gen Zs are even younger. And basically they're trying to move away from credit. They don't like credit. In some cases, they don't even qualify for credit. And perhaps they don't have forms of income that do allow them to pay for certain things up front, but they do want to get them up front. And so this is the way these products are designed, that they're very appealing in their ease of use and in their design for the younger demographics. And so from the merchant's perspective, it's quite attractive to offer this feature, this functionality, if you do want to attract this category of buyers that do have a lot of buying pool, so to attract them to your store or to your e-commerce site. That's the first thing. Now, the other thing that's quite interesting as well is it's a form, especially in the case of a company like Afterpay, and I'm sure we'll get into the details there, is it can be used as a form of customer acquisition, right? So sometimes customers do use it to explore and find new offerings on that platform. So it is a form of customer acquisition. And I think the critics out there will rightly point out that this sounds exactly like Laybuy as it used to be known back in the day. And in a sense it is, but it does embed a form of technology within that. And so in a sense, the way it's been cleverly designed, cleverly worded, in the sense that it's not actually credit. And some of these offerings don't even impact your credit score, even if you miss a late payment in some cases. So that really becomes fascinating. And some of the operators in this space don't even perform any credit checks. So you can still get the buy now, pay later offering without any credit checks being performed on you. And as long as you don't get into any form of late payments, your account will remain valid and operating. So it's quite an interesting thing, but at a high level, that is buy now, pay later.
Kevin, that's a great summary, mate. Don't for a second believe I didn't notice you talking about millennials and then Gen Z as if they were somehow things I didn't know anything about. I'll get you later for that one. Mate, it's fascinating too, because you mentioned the customer acquisition, you mentioned the credit. Is it credit? Is it fintech? Is it technology? Is it, what is buy now, pay later? It's kind of all of those things, right? And it's none. And the hard part for investors is trying to break it down and really kind of segment it. Because if it's just providing credit like Visa and MasterCard, then you kind of think, okay, well, credit margins and credit risks and long-term, growth, how much can they really take and what does the pie look like? On the other hand, you already talked about the customer acquisition story and the fact that once you start using Afterpay, you're almost Afterpay first rather than retailer first. And that brand, not necessarily loyalty, but the brand experience and the experimentation kind of comes along that path. There's probably somewhere in between that too, which is just that sheer, I guess, reality of what it means for the merchants. You've already talked about that. I have said before, and I'll say again, and my own stupid fault for not buying the shares back in the day, but they used to just simply put on their investor presentations that, I can't remember the number now, it's somewhere between 30 and 60%, which is a big gap. But they would simply go to a merchant and say, hey, when people like you have offered people Afterpay, sales have gone up by between 30 and 60%. And for that, if you can pay 4% of sales rather than 2% for Visa or MasterCard, for example, yeah, it's more money than you'd want to pay, ideally, $4 out of every 100 rather than $2 out of every 100. But if you can turn your sales from 100 to 130 in the process, it's a pretty good ROI. It's a very good ROI for retailers. It's not surprising that retailers jumped on board. For consumers, why wouldn't you want to pay later if you had the choice? If you get the same product at the same point, you don't have to pay for a while. Well, hey, why wouldn't I want to? It kind of solved a problem that no one knew we had.
That's absolutely right, and it does. And I think that the bottom line is the retail space is incredibly competitive, especially these days with e-commerce. We do have more data into exactly how consumers are behaving. So e-commerce players can tell if someone's browsing on their site, if someone puts certain goods into their basket, and if they don't complete the checkout and actually purchase the products. Companies like Afterpay, and full disclosure, I do own shares in Afterpay, they've been able to demonstrate to their merchant customers that consumers who do have Afterpay do have a higher completion rate. They do have a higher rate of going through to the checkout and actually purchasing the products. So from the merchant's perspective, yeah, you do have to pay that 4 or 5% merchant fee hit. But then if you are making that up in volumes and additional people actually going through and completing that checkout, then financially that could make a difference for you. Also, there's this whole, I guess you could call it a network or cyclical thing where if your competitor is offering Afterpay and you're offering a similar product that's not really differentiated from your competitor, once everyone starts doing it, it really becomes hard for you to be the only retailer that does not offer this service. So it's one of those things where once companies like Afterpay have been able to convince the major retail outlets to get on board with this trend, it just becomes easier to convert more and more merchants.
It goes from an opportunity to a potential cost if you don't have it. Mate, okay, let's move on. Rhino, give us some stats on Buy Now Pay Later. I know you've been doing a bit of work on this one. Just kind of set the scene before we go into the companies themselves. Just take us through the current market, the current circumstance, current situation when it comes to the Buy Now Pay Later space.
Yeah, before I do that, Scott, I'm actually going to throw one question back at you, and it is relevant.
Not about old people, thank you.
Look, you're often seen as the voice of reason, the VOR among people. So I want to get your thoughts on this before I get into some statistics.
I'll do my best. I've set up here, I'm sure, guys. Let's see what happens.
You mentioned a minute ago that you made your first Buy Now Pay Later transaction.
I did.
This week, last week?
This week, I think it was this week.
I'm curious, what actually spawned you to do that? Because in the past, you have been quite critical, I suppose, of the sector that that it is credit and people can use it unwisely. So I'm just interested in your thoughts there.
Oh man, I'm going to try and answer this quickly. I will say I'm critical of the product as potentially a gateway to credit and not being regulated as credit. I think those things are from a financial advisor's perspective, thinking about the benefit or otherwise of Buy Now Pay Later for the community. I think we have a potential issue with it. I think it should be regulated as credit. Let me put it out there. The transaction was a PayPal Pay in 4 one. I said I'm a PayPal shareholder, again, to say again, for full disclosure. And I was just on the site and I clicked the PayPal button. It took me to the PayPal authorization window. And at the top, it had a little pop-up that just said, hey, do you want to pay in 4? Click here. I went, oh, give it a try. Why not? And that was literally, so no forethought. And so, you know what, if we're going to pay the money, I might as well, let's put some audio gear, actually, one of these headsets. I might as well pay in 4 rather than pay up front because there's no reason why not. And I might as well experience the process. So that was what happened for me. I don't know how typical that is. I don't imagine it's very typical, but that was my journey.
No, I like it. And that's a perfect segue into some of these statistics. I'll refer to research here by The Ascent. And The Ascent is a Motley full service over in the United States. And it basically markets itself as a money concierge. So think of it that way. They do research on credit products, on money products. So that's what The Ascent is. Mm-hmm. The Ascent surveyed 2,000 Americans. So it's a fairly small sample, but I think it's reasonably reflective of what the broader community would be. 55.8% of consumers have used Buy Now Pay Later. And that compares to 38% in July 2020. So, and maybe it's up to around 60% by now with people like yourself converting as well. So that's a real plus.
I think slammed here. We say people like yourself, Ryan. I know exactly what you're thinking, by the way, mate. But
the older generations.
Yeah. Let's keep going.
So look, I think this is a pretty well-established point that Buy Now Pay Later is particularly prevalent among the younger generations. I'm going back to that age group, but statistically speaking, between 18 and 24-year-olds. So 61% have used it in that group. And as you start getting towards the older generations, defined as over 54 by this study, 41% had used it there. So
it's still pretty good, mate. That's
still pretty good. Yeah,
I expected. Yeah.
Yeah. So I look, it's certainly growing in prevalence, and I think as well as people start to question whether or not they actually want to risk paying those credit fees, as you mentioned a minute ago as well. Yeah. And also 53% of respondents said they would be interested in using Buy Now Pay Later within the next 12 months. So those that haven't used it are actually interested in and intrigued by it. 62% of respondents also said that this could potentially replace their credit card. Now, a lot of people don't actually want it to replace their credit card. There's sort of that status quo bias. They want to sort of stick with what they know. But I mean, look, Buy Now Pay Later, it is still a relatively new segment, and it's a new way of thinking and a new way of spending for a lot of people. So personally, I think over time that frame of thinking could potentially change. A couple of really interesting things, though, from this study that I found. So many users of Buy Now Pay Later, 64%, actually increased their usage during the pandemic. And this is really reflective with what we've seen from a lot of the earnings reports issued by some of these companies, Afterpay being among them, ZipPay as well. I think part of the reason for that is it has been to preserve cash in case of emergencies. And the study found this as well. 41% gave that reasoning. So I guess budgeting. And this is really what Afterpay has sort of been saying all along, that it is helping its users to budget and to save money and spend responsibly. And I mean, that view has been questioned by quite a few. It's certainly, I guess, been looked at by the regulators too, whether or not that's just a marketing angle or whether it's true.
Yeah.
But I mean, look, I guess the pandemic has provided some element of proof behind that argument. Also, another key finding is that 45% of respondents had used Buy Now, Pay Later to make payments that didn't necessarily fit into their budget. And this is, I guess, has been part of the appeal as well, that let's say you're purchasing something worth $500 and you only get paid $1,000 on a weekly basis. I guess $500 of that $1,000 is a big chunk. But if you can potentially spread that over four fortnights, then that really does spread that burden. So I think there is certainly appeal to this as a spending option. A couple of other reasons for using the Buy Now, Pay Later services. So I mentioned to make purchases that wouldn't fit in the budget, 45%. There were also others that literally said, I've just been shopping more through the pandemic. And I suppose that sort of provides the flip side of that argument, that Buy Now, Pay Later does give that potential to increase your spending, potentially unnecessarily, potentially unwisely or irresponsibly. So I guess there are arguments to that, as Kevin mentioned before. It's certainly been explored by the regulatory bodies around the world, particularly in Australia. So yeah, there's I guess the questions or the definitions, the questions, and the views of Buy Now, Pay Later are certainly dynamic, just as dynamic as the sector itself.
Nice, mate. That's an awesome summary. Now, gents, you've done a great job of getting us into the sector, explaining what's going on, where the opportunities are, the sort of size of the market, potentially how Buy Now, Pay Later is being used. Now let's get into some specifics. We know a lot of these companies. We've heard a lot about them, but I want you guys to just talk us through each in turn, if you wouldn't mind, at least the top half dozen or so. Let's kick off with what the company has as its product features. And let's talk a little bit about then the company itself as an entity, as an investable entity. We'll hold our investing recommendations or otherwise to a bit later on. Let's just start with you, Ryan, for Afterpay. Maybe would you give me a run through of what the company's products offer specifically? So we've talked a lot about Buy Now, Pay Later generally. Let's go to Afterpay specifically. What does it offer? What are the consumers getting or not getting? What's it costing them? And then let's go into the company itself.
Yeah, look, I think it absolutely makes sense to start with the behemoth in the industry. Afterpay is really
$39 billion behemoth, as we know now.
Absolutely, yeah. So look, I think Afterpay is really the pioneer in this industry. It's really, I guess, kickstarted the revolution, so to speak. So basically, the model that it provides is a pay in 4 solution. So 4 equal installments paid over between 3 and 4 fortnights. So for initial customers or customers that are only just starting to use the platform, it will require the first payment up front. As you build loyalty and as you build trust in the platform, then you can actually make that initial payment 2 weeks later. So pay over 4 fortnights. And it's essentially become a verb, right? Yeah. So, I mean, you don't have people going around saying, oh, look, I'll go and PayPal that. You know, you go and Afterpay it. You know, I'll put that on Afterpay. That it's become a verb. And I think that's a really powerful platform or really powerful base from which to build. It's very consumer oriented. So as Kevin was highlighting before, there are different fees or different structures or business models associated with these Buy Now, Pay Later giants. Afterpay in itself, the only way it actually generates revenue from consumers is when there is a late fee. And even at that rate, it's capped. So it's capped at 25% of the overall fee, or I believe $68 is the maximum late fee you'll pay. Other than that, though, it actually generates the bulk of its revenue from the merchants itself. So it goes to those merchants and it says, look, how about you offer Afterpay as a payment solution or a payment alternative? you pay between 3% and 6% or thereabouts of the underlying transaction to us. And in return, we will provide that fee. We will give you the money up front, and the consumer themselves will pay that money back to us over time. So Afterpay in itself is actually accepting that credit risk. It's, as Kevin mentioned, it's boosting the conversion rates at checkout. It's boosting the sales numbers. So let's say you were a retailer and before accepting Afterpay, you were generating about $100 of revenue. Using Afterpay, you can actually increase that to about $140 based on what the company, the statistics that the company has provided. So that's a massive increase, particularly for smaller merchants, I guess, that are operating potentially in regional areas or may not have access to such huge audiences or huge consumer bases. So I think it's really interesting. In terms of the business itself, as I said, industry behemoth, about $39 billion market cap or $37 billion market cap. In the 12 months to June 2021, $978 million in sales, and $822 million of that, so roughly 85% or thereabouts, was from the merchants themselves. A much smaller base from the consumers through late fees. And that was up 78% year on year. And believe it or not, that was actually impacted negatively by unfavorable currency movements. I think it was about 91% on a constant currency basis. So it sort of just goes to show how incredibly massive this business and this entire opportunity is, that it can be growing from such a large base at such a high rate. As I said, for the merchant, there are a lot of benefits. One of the benefits that I like to refer to is if the merchant themselves might be paying between 3 and 6% of the underlying transaction, which is more than what they would pay for a credit card transaction, for instance. At the same time, however, they are receiving marketing essentially from Afterpay. They're receiving Afterpay generated about 1 million referrals on average per day throughout the financial year 2021. So incredible marketing alternative as well. Now, of course, this business has recently been announced that it would be acquired by Square. So assuming all goes to plan, this business probably won't trade on the ASX directly for much longer. It's expected that the transaction will be completed in early 2022. However, at that time, it is expected that Square itself will trade on the ASX. So investors can still have indirect access to Afterpay through an ownership in Square. As I said, that's still to play out. May not happen. There's a lot of I guess contingencies to make sure that it does. But so it's not definitive, but that's the way it's certainly going at this point.
Nice, thank you, Matt. A really good summary of Afterpay, the absolute, as you say, behemoth in the category. From memory, the Australian All Technology Index, the relatively new stock market index, Afterpay's in there. And I want to say Afterpay itself is something like 2/3 of the market cap of that entire index, which gives you a sense of not only how well Afterpay has done, but how big it is compared to not only the rest of the buy now, pay later sector, but the Australian technology sector broadly. Just a massive, massive, massive winner and a great story, I think, of Australian success. And we should probably celebrate that as well, that whatever happens to the Afterpay share price or the Square share price from here, taking a brand new payment method to the world is impressive. Ryan, I also will mention, as I did at the top, if you're worried or interested about the takeover, those videos on YouTube, both the general Square Afterpay video and the what happens to my Afterpay shares bit. You've mentioned Square trading on the ASX. We go into a lot more detail there on those videos. So do check them out if you want more information on that one, or you simply want to find out more about the Afterpay and Square business. Kevin, let's go to you, mate. The second, maybe distant second, but still credible second in this sector is Zip. Its CEO for a long time was complaining about the fact it was being overlooked and forgotten about, and Afterpay was the story. Zip really struggled to get airplay, attention, mind space from investors and the media alike. That being said, 2021 has been a pretty good year for Zip, at least up until recently. I'm sure even better now since the takeover was announced of Afterpay. But the Zip story, mate, second player, but still a good player, good size player in its own right.
Yeah, that's right. Second player, but really not. I mean, there are at least 10,000 other players behind Zip, right? So it could be worse. I do feel bad for the CEO, but yeah, it could be worse.
Yep.
Look, yeah, Zip is generally regarded as the second player in the market behind Afterpay. But I do think there are some key differentiators that they've tried to implement in their business model just as they try to just navigate this market alongside some of the other players. Now, the first thing that pops out to me as I do research on this company is that they now actually have a presence in around 9 global markets. In Australia, New Zealand, and the UK, they operate under this Zip brand that we all know and are familiar with. But they've also made acquisitions in other geographies. In the United States and in Canada, they acquired a company called QuadPay. So they operate as QuadPay in North America. In Poland and Czech Republic, they actually have a presence there, and they operate as Twisto. That's the brand there. And then in the UAE and the Middle East, typically around Dubai, they have a presence there. They acquired a company called Spotty. And then they also have a presence in South Africa. They operate there as Payflex. So that's quite interesting. They're trying to expand in different geography and take this to other geographies. We know the US and the UK have been the main countries where these buy now, pay later operators are trying to expand into. But interesting that Zip has also, in addition to those geographies, picked continental Europe, Middle East and Africa as well to expand. So that's the first thing. The other thing is that in terms of the actual products that they offer, they also have, outside of the traditional buy now, pay later, they also have Zip Business, which basically is working capital finance. They launched that offering. So they are, I guess, looking at this broader financing model and trying to bring a newer age twist to it. They do also have the Zip app and trying to offer, I guess, functions and features that help consumers with things like budgeting and managing their finances and things like that. So they're trying to be a holistic overall finance offering for consumers, which is quite interesting, especially as that develops over time. But just focusing specifically on buy now, pay later, they have 2 main products in this space. The one is Zip Pay, and then the other is Zip Money. Zip Pay is usually for transactions that are usually lower, so between usually below $1,500 is where they offer that Zip Pay product. So if you're trying to make a purchase and it's below $1,500, you typically just pick the Zip Pay product. This one is actually interest-free, so you don't actually get charged any interest for Zip Pay. You can choose their flexible repayment period, so you can choose what works best for you. Typically, you're paying back anywhere between $40 to $80 a month to get back to that $1,000 or $1,500 payment. You do get charged a monthly account fee. It's a small amount, $6, but I guess for some consumers that can be annoying compared to Afterpay to actually be charged that fee. And then looking at Zip Money, that's usually for larger purchases. They can go as large as $50,000 depending on the merchant. And usually it's interest-free up to 3 months, although sometimes they do have promotional offers of between 6 and 48 months. So this product seems more traditional, like a credit card offering. And this is the one I find quite interesting. With Zip Money, you can actually get charged interest after that interest-free period is done. And that interest can go as high as 19.9% per year. So it is quite a hefty fee. Just looking overall at the company, it's a $4 billion market cap, so not quite $30 billion, but it is a $4 billion market cap. Earnings, EV to sales, so the enterprise value to the sales, just looking at that multiple there, it's around 15 times. So it is quite a high multiple, but then again, the company is growing at a pretty significant pace, around 155% sales growth. So that's pretty significant. They've got around 7 million customers, and their transaction volumes continue to increase well over $5 billion now at this point. So yeah, Zip is an interesting company. It is second to Afterpay in its size and in its reach, but that doesn't mean that it's not a growing company. The entire sector is growing, and we can see that in Zip's growth rates.
Fascinating, KG. It feels like it's kind of half Afterpay, half the traditional Harvey Norman 48 months interest-free. Some combination of all of those is kind of Zip's, I wouldn't say sweet spot. It seems like it's spreading itself reasonably broadly across the sector to try and have its fingers in as many pies as possible. Is that a reasonable summary of how you see the business?
Yes, that's right. They have been expanding their product offering. I mean, it is quite an interesting strategy because initially you may think as a smaller company, they may be spreading themselves too thin, 9 geographies, different product offerings.
That's right.
But this company has managed to make it work. And I think the key for them has been, if you look at a product like ZipPay, for example, one of the interesting things they've been able to introduce with that is that you can actually use ZipPay anywhere where a Visa card is accepted. So they've managed to work that into the backend technology. So that's really interesting and cool. So it just means that it just becomes a little bit more widely available. It's helped them with the take-up rates with consumers.
Nice, thank you, mate. Now, Chris, back in the day, as Kevin Simon helpfully mentioned, I'm still pretty sure you guys are ganging up on my age. Back in the day, we used to have this thing called Laybuy, where you'd choose your product, they'd put it in the back room, you'd go and pay your $10 a week or whatever it was. And when you got to finally cover the cost, you got to pick up the product. Plenty of people used it. Things like kids' Christmas presents was super common, right? You kind of pick up the toys in July or August, you go and pay your money, and you pick up the toy, whatever it was, in November or December. So Laybuy was the thing. Then it became buy now, pay later. And now buy now, pay later has become Laybuy. So just to confuse things a bit further, it's a New Zealand company, I think, from memory, calling itself Laybuy, but offering a buy now, pay later service. Talk us through the business called Laybuy.
Yeah, that's right. Called Laybuy. It's an interesting name considering the history. Before I quickly jump into it, I want to make sure I disclose as well that I own shares in Afterpay, and I also have a small holding in Laybuy as well. But
man, thank you.
So, Laybuy operates in Australia, New Zealand, and also in the UK. And the business actually has quite a strong position within the New Zealand market, being one of the market leaders in the region, along with Afterpay and Zip's the other. One of its key competitors in there as well. And around 2 years ago, the business then launched its product into the UK, and already the transaction value it generates from the UK, it exceeds that of its transaction value in Australia and New Zealand as well. And so too does its active customer count. So this shows, I guess, the opportunity for buy now, pay later as a whole as it moves out of Australia and grows into the bigger, more attractive, larger retail regions. So yeah, Laybuy also works slightly different to Afterpay in that customers pay off their purchases in 6 weekly installments rather than 4 fortnightly installments. It also has an added built-in feature that allows customers to change payment dates for the final 5 installments before they confirm their purchase as well. And this adds additional flexibility as well for the customers. It also has a product called Laybuy Boost, which essentially lets its customers spend above the available $1,000 limit as long as the customer pays the amount that they are short up front. So, for example, if a customer buys a $1,300 TV, then they pay the first $300 up front, and then the remainder of the purchase will be split across the 5 remaining.
Oh, that's quite clever. Okay.
Yeah, so it's an interesting way of doing it as well. And Laybuy also launched its Tap to Pay product late last year, and that allows customers to make purchases in store with just tapping their smartphone as well, which not all buy now, pay later products do that. So it's another interesting development. Laybuy also charges late fees. It doesn't charge interest like the rest of these businesses, and it doesn't have other hidden fees. In terms of business performance, the company's been doing quite well. So it has a market cap of just over 100 million. So it's one of the smallest ASX listed buy now, pay later companies on the market. It's got around 830,000 active customers. And it's also the cheapest pure play buy now, pay later company in terms of valuation of the businesses that we'll be discussing today as well, at an enterprise value to sales multiple of just under 4 times. And in the last financial year, the company grew revenue by 138% to New Zealand dollar 32.6 million. And much of that growth came from the UK as well. But in the recent quarter, so it's just recently announced its first quarter of the financial year, revenue growth has slowed, with revenue was up around 70% compared to the first quarter of 2020. But so yeah, that's a bit about Laybuy.
Fascinating. It just goes to show how, I mean, there's a lot of players in this space. I don't think any of us expect they'll all survive in their current form in 5 or 10 years' time, but it is amazing how much innovation is happening to differentiate, add to, I was going to say consumers will be the winner. Again, I'm not 100% sure whether we would all lose having buy now, pay later around, but the innovation here and just the different companies doing different things, you can imagine the features get taken up in one way or the other and enhance the offering overall for the successful buy now, pay later operators over the long term. Excuse me, sorry. Ryan, excuse me. Let's go to another one. There's plenty more. SplitIt. Love the names, by the way. There's some decent consulting money being spent on naming this here. What is SplitIt, mate? How is it different, or is it different from the other ones we've just discussed? What's the business offer, and what is the business structure and size?
Yeah, all these business names give a pretty good idea of what they do, don't they? So SplitIt. Look, look, as you guys have already covered as well before this, buy now, pay later is really quite innovative, and it's not a one size fits all. So there are a range of different businesses that are offering different solutions, different approaches, and also different customers that are going to, I guess, gravitate towards each of those different approaches and offerings. What SplitIt does is it also offers monthly installments, no consumer fees, no late fees, also no interest, like the other buy now, pay later operators. And it really offers flexibility for the consumer. So whereas you've got an Afterpay that's requiring fortnightly payments, the consumer with SplitIt can actually elect to make their repayments over flexibly over a number of months. So they can, at the point of sale, they can actually choose whether they want to pay that over, say, 3 months, 6 months, 12 months, 24 months. Okay. And that can actually, I guess, make a difference to how much they pay per month. So if they're paying over 24 months, obviously divide the total amount by 24. It makes it a much more manageable product. And I think in terms of why a merchant would want to offer this on top of something like an Afterpay or a Zip or a Laybuy for that matter, it offers more flexibility. It offers more consumer choice. And I think in this case in particular, it probably provides a greater flexibility for the consumer to purchase larger ticket items. So if you're purchasing something worth, say, $2,000 and you have the option to pay that over 24 months, it really does reduce the amount you have to pay up front. Jury is out as to whether or not it is responsible to do such a thing. There are different buy now, pay later methods that I think are probably more responsible than others. But yeah, it is an offering that consumers can have. So yeah, as the way it works, basically, let's say you spend $500, you choose to repay that over 10 months. Basically what happens is SplitIt seeks authorization from the card company. So it sort of, I guess, works off existing debit or credit cards, particularly debit cards now. It's shifting away from the credit card use, but it really seeks authorization from the credit card company to reserve the total purchase amount on your line of credit or debit card. And then as you make each repayment, obviously that repayment reduces the amount reserved against your card limit. The business itself, about $240 million market cap or thereabouts. And it measures its sales and also the underlying merchant volumes in US dollars. It does operate across a range of different geographies, I should say, America, the UK, Australia. And sales growth for the trailing 12 months is 150%. So that sounds really, really impressive. One knock on that, though, what I will say is the merchant sales in the past quarter, the quarter ended June 2021, the sales were, and I'll say only because it's relatively speaking, but only up 38%. So there has been quite some deceleration there. And that was down from the first quarter in which merchant volumes were up 247%. So as I said, relatively speaking, 38% is quite low. There are a few reasons for that deceleration. One, the company's deliberate shift away from credit cards and more towards debit cards. That does impact growth, but the company argues does consider, I guess, significantly de-risk its business and its offering. So you can understand that. It's also had a tough comparable. So obviously the prior quarter was at the peak of the COVID pandemic when, as I mentioned previously, buy now, pay later sales were going through the roof. So there is that, although other buy now, pay later operators have been posting some pretty strong results. So again, relatively speaking, I think that was quite a low result. The company also mentioned customers returning to shop in store as being one of the issues. And the company's innovated here more recently, and it's released SplitIt in store so that customers can now use SplitIt when shopping in store as opposed to just online. So that is one innovation on the company's behalf, although other companies like Zip and Afterpay have obviously been doing that for quite some time. And the company also cited some delays in the merchant rollout. So look, I guess for a smaller business compared to the Zips, the Afterpays of this world, I guess it isn't ideal that you see a company this size experiencing that slowdown in growth. At this point, growth could well come back, and the company is expecting a re-acceleration in growth. So there is that. Shares are down quite a bit over the past 12 months or so. I believe they're down about 61% or thereabouts. I think I'm looking at the right line. 65%, I think it is. So haven't performed quite as strongly as some of those other buy now, pay later operators. Could be one to watch, but yeah, I guess we'll wait and see what we have to say at the end of this video.
We will, whether that 65% is an opportunity or something to be avoided. Let's go to Chris. Chris, so back in the day, when old people were still, like dinosaurs roaming the shops, and you guys weren't yet born, there was a thing called Flexi Group, and a product with the very, very worst brand name ever in recorded history, Certegy Easy Pay. I swear to God, speaking of consultants coming up with new names, that was just remarkable. But it has some claim to be the originator of buy now, pay later. It was the engine that drove things like the Harvey Norman 48 months interest free, the JB Hi-Fi kind, that sort of stuff. This idea of, hey, no interest ever, come and grab it now, pay it back later. That was the kind of, to some degree, the brainchild, or at least the kind of, the right, the birthright of Flexi Group. Now, Flexi Group's now called Humm. They've kind of got rid of most of that. They've rebranded. They've released a new product. They're still trying to say, look, we originated this stuff, but gee, they got absolutely left behind. What is the new Flexi Group, now called Humm, got to offer for consumers?
Yeah, so as you said, yeah, it's an interesting business, and it's interesting going back to the history as well. So originally, as you said, it helped consumers pay off the big ticket items for over a longer period of time, often interest free. So this is quite similar to the buy now later products we see now, but there are some slight differences. So, for example, if you look at its Flexi Rent solution that it had back in the day, which was one of its more original offerings, where the business would offer, I guess, a low weekly rental payment for the use of a product, but the total payments that the customer would make would end up being more than if the customer purchased the product outright. Yeah. So opposite to the
likes. It's quaint now, doesn't it?
Yeah. This is how the model sort of really worked, I guess. So opposite to the likes of Afterpay and I guess your modern buy now, pay later products now, which make their money off the merchants. Flexi Group actually made its money off the consumers. So when the more, I guess, the consumer-friendly buy now, pay later products entered the market, it quickly became a more attractive, I guess, solution for its consumers. But yeah, recognizing the changes in the market and the adoption of buy now, pay later, eventually, Flexi Group ended up rebranding under its buy now, pay later solution, which was eventually named Humm. So now, the business is called Humm, and it has a number of different offerings in the buy now, pay later space, including its bundle product. So bundle allows consumers to essentially bundle their weekly transactions up to $1,000 and then repay this in 2 weeks' time. And the cool thing about this product is that it's available at any location that a MasterCard is accepted. Customers can just download the app and then add their bundle card to their digital wallet on their mobile phone and go from there. So the company also has its Humm product, which is aimed for expenses between $1,000 and $30,000. So again, the bigger ticket items. So these have repayment options from 10 weeks to up to 60 months, depending on the product. And the company, on top of its buy now, pay later solution, also has leasing, credit cards, and other business financing solutions as well. So it's not a pure play buy now, pay later business, but it is profitable, which is something that differentiates it from many of the other buy now, pay later businesses around at the moment. So Humm and Bundle do charge late fees, and there are other fees for bundles such as international transaction fees. It has something called super bundle fees, which is for when you want added flexibility, such as extended fortnightly repayment plans. So instead of just paying in a couple of weeks, you can extend it. And it also has a snooze fee for when customers aren't in a position to make a particular payment. And for Humm, there are sometimes monthly fees or establishment fees for larger purchases being paid off over longer timeframes as well. So that's something that the consumer needs to keep in mind as well. For Humm Group, in terms of its financials, it has a market cap of just under 500 million and a valuation of just over 2 times sales. It has total customers of around 2.7 million and well over 2 billion in transaction volumes. Around 1 billion of that relates to its buy now, pay later products though. And in terms of its growth, its buy now, pay later transaction volumes in the last financial year increased by around 31%. But this was partially offset by a decline in transaction volumes for its Australia and New Zealand cards business as well. So yeah, this isn't a pure play buy now, pay later business, but it's definitely a business looking to grow off of the same tailwinds, and it's rebranded its business in recent years, I guess, to help it achieve this.
Nice, mate. You know what I love? I love the idea of the snooze fee. Rather than saying to people, you're going to get charged a late fee, you get to effectively elect the late fee up front. You call it a snooze fee, and then people get to select they get to pay it later. So it's a nice way of kind of, if you're into behavioral finance and that kind of stuff, just relabeling something differently, calling it a snooze fee rather than a late fee, same dynamic, but somehow it feels less arbitrary and less onerous. Mate,
absolutely.
Sorry, mate. Say again.
Yeah, it sounds more fun. Absolutely.
Doesn't it? It sounds like you're choosing it. Yeah, exactly.
Yeah.
Hey, while I got you, let's go to Sezzle. Another one of these. I don't know what Sezzle's. The other one's kind of, well, Humm's probably the same actually. They're just making up names now. Sezzle. I can't imagine it actually means anything in particular. What is it? What does it offer? And what's the company structure and attractiveness?
So yeah, Sezzle operates in the US and also in Canada, and just like Afterpay, it's a founder-led business with the co-founder owning more than 40% of the business as well, which certainly aligns his interests with shareholders. And just like Afterpay as well, customers pay the transaction across 4 fortnightly interest-free payments. So the first quarter of the transactions paid at the time of the purchase, then the next 3 are spread evenly into 2 weekly intervals after that. And Sezzle has late fees as well if a payment is missed, though the company does offer reschedule payment options, reschedule options for payments, but I guess the first reschedule for the order comes with no fees. But if the customer does want more than one reschedule for a particular purchase, then they will need to pay a fee for each additional reschedule after that. So Afterpay, for example, only allows customers to move payments per order once. So this does create added flexibility, though it comes with a fee. So that's, again, something for consumers to consider. Sezzle also has other interesting features, including Sezzle Spend. So this is where customers receive points when shopping through various promotions, and then they can apply those points towards certain purchases down the track, which is an interesting feature.
Yep.
It also has a Sezzle Up feature, which is something I hadn't seen in any of the businesses, where customers can enable Sezzle to report their payment history to the credit bureaus. And through applying this option, customers, assuming of course that they make their payments on time, they can improve their credit score and increase their spending limits.
Oh, that's cool
as well. So
okay,
that's an interesting feature.
Yeah.
And it also offers a Sezzle virtual card that customers can sign up for and get a spending limit based on a soft credit check. So so it doesn't necessarily impact their credit scores, and it often requires less details or challenging and time-consuming information to fill out for the customers. Customers can then purchase from select retailers, add the card to Google Pay or Apple Pay, and do one-tap purchases from there. So in terms of financial, Sezzle's growth has been one of the more impressive of all the buy now, pay later companies on the market in recent years. So it currently has a market cap of just over 1.5 billion. And an enterprise value to sales multiple of just over 14 times, which makes it one of the more expensive buy now, pay later companies, though still at a steep discount to what you'd pay for Afterpay, for example. But yeah, its growth has been impressive. The company already has nearly 3 million customers, and in the last 12 months, it's grown sales by around 150% as well. So this is a business that is growing quickly. It has a high valuation to justify that, but yeah, it's an interesting company.
Remarkable. Again, more innovation. Really cool. I got to say, you guys are the experts here. I get to just sit here and ask the questions, but hearing about some of the innovation, I'm kind of, as we're going through, I'm thinking, there's another company. Sure, there's not another way to innovate, but everything's like, as you say, those reporting, your credit score, for example, proving your credit score, the loyalty points. Every time we hear about a new business, they've got something new to offer. So, Kevin, here's the challenge. I'm going to ask you about Openpay. I'm going to see if Openpay can keep the ball rolling, keep the streak. How is Openpay different, or is it different to the other companies you've just talked about?
Yeah, no, that's a very interesting question, because Openpay, on the face of it, is quite similar to some of the other companies we've spoken about. They do have started in Australia and New Zealand, as many of these companies have expanded into the UK. Actually, interesting enough, the UK is now their major market in terms of where a lot of their payment volumes are coming from. And they're looking to go into, guess where? The US market sometime around October. Now, looking at this, just some of the key features of their plans. I mean, they don't charge interest. So again, that's very similar to the rest of the companies in this industry. They do charge late fees, and they do have some what they call management fees, depending on the type of plan that you have. One of the different go-to-market strategies there is they do try to offer a level of flexibility for consumers. So you can kind of choose your own length of payment plans depending on what suits you best. So you can choose anywhere between say 2 months to 24 months. So you can actually be paying for up to 2 years and up to $20,000 of transactions. They do also, which I find quite interesting in terms of a go-to-market strategy, they do target specific verticals. So things like home improvement is a vertical that they specifically outline as a target market for them. And then companies like Bunnings are merchants that they partner with. They also target like the automotive industries, car dealers, and that sort of thing. Education is another industry that they target. So they just try to understand the specific dynamics in those industries and offer plans that are quite suitable there. And another one that I particularly found quite interesting is they do actually target merchants in the membership industry. So particularly, they've actually recently signed AFO clubs. I know on the call today we've got some AFO fans. I know Ryan is a Saints fan, and Chris is a Brisbane fan. Go Brisbane! So for those gents who are fans of those clubs, you can actually purchase scarves or jerseys or whatever the case may be using Openpay and get those scarves now and pay them later. So that's what I find interesting about this company. It is a relatively small company. Market cap is around 136 million. The enterprise value to sales there is around 5 times, which is lower than some of the other competitors, but also it's not growing as fast. Sales is up around 44%. So it's a company that's still, I guess, in the earlier stages. They're still launching in certain geographies. Scott, one of the things we notice when we look at these companies, growth by geography is typically tilted towards the US. That is where most of the growth is coming for these companies, and Openpay is still to enter into that market. So I think growth, if they do successfully enter that market, growth could pick up, but it also depends how it is becoming a more competitive market in that particular geography. So it just depends how successful they are into entering that space. But yeah, that's Openpay, a little bit different, but in a sense, more of the same.
I think the biggest issue with Openpay, mate, is they're trying to sell Lions and Saints scars. They're selling Swan scars. Are much better off, just quietly. I'll Ryan, you get next right to reply, mate, because I'm going to ask you about, we've gone through 7 of the most prominent, if you can believe it, it's not the whole sector. There's still another 3 or so ASX listed companies. Just quickly touch on, if you wouldn't mind, mate, the other 3 that I'm not going to cover in detail, but just to try and round out what's close enough to a baker's dozen, not quite, but we're not far off. Another couple of buy now, pay later players are just kind of there or thereabouts in the space.
Yeah, look, I mean, that's not all, is it?
There's more. Exactly.
Some of the major banks are also venturing into this space.
Right.
I think you might have mentioned Citibank was looking at expanding into buy now, pay later too. So it's getting larger and larger by the day. But I guess honorable mentions to a couple, and as you said, I'm not going to go into much detail here. IOUPay, ticker code IOU, has recently ventured into buy now, pay later.
Good ticker, just really quietly. So, someone else should have come up with that first, I reckon. I
feel the same. Yeah, it's still very early days. They're only generating about $500,000 or thereabouts in underlying transactions at this stage. It's also very Malaysia focused. So my understanding is that you need a Malaysian credit or debit card, as well as a mobile number and email address also in Malaysia. So early days for IOUPay, very Malaysia focused. Latitude Group is another one with a buy now, pay later offering.
That's true.
They offer Latitude Pay, which I believe is 10 weekly payments. And a much smaller one, which I'm really not going to cover in depth here, is a company called Dough, formerly Ziptel, and I believe that trades on the ASX with a roughly $30 or $40 million market cap. So a much smaller business than a lot of the ones that we've covered today.
There you go. That's 10. We got to double figures. Before we get to our favorite stocks, I guess I want to talk about, look, when we normally do a recommendation, we normally give an investment view, we talk about risks, and we won't cover each individual company, certainly not even the ones that we're going to suggest are our better ideas in the space. But if we think about risks, I guess the first thing I want to ask you, Ryan, given the run through we've just gone through, I can't imagine a future where these 10 buy now, pay later providers all exist in their current form. And I guess I'm curious as to, without going into company specifics, do you have, if you look in your crystal ball, how many of these survive in their current form? How many, what does a future look like? Surely there can't be 10 buy now, pay later players in 5 years' time.
Yeah, look, I feel the same. I think buy now, pay later on its own, I think, is a very risky strategy. And one of the reasons that I've liked Afterpay, a company that we have recommended before, is that it's not just buy now, pay later. It does have other offerings. It offers merchants with, as I said before, roughly 1 million referrals per day. It's also a very catchy product, very trusted by particularly younger generations who are, I guess, against credit cards and traditional credit. So that in itself was solid, and I believe still is and will be under Square. Other companies, though, that are providing just a buy now, pay later offering, I believe that, in my opinion, buy now, pay later is becoming more of a feature. And I think that's really been exacerbated by, I guess, Apple's venture in, PayPal's venture into buy now, pay later, now Square's approach to Afterpay as well. Particularly in the past few weeks, I think that risk has really dramatically increased. Now, I think one of the things with Afterpay is that it has, with Square purchasing Afterpay, I believe it is largely about time. So they're saving a significant amount of time in purchasing Afterpay rather than going out and trying to build its own buy now, pay later offering. With some of these other smaller companies that many of which I believe have, I guess, rallied in response to Square's takeover offer, I don't think they offer that same advantage. If a company was to go, if PayPal, let's say, was to go out and acquire one of those smaller buy now, pay later offerings, it's not really saving that much time. It's not really generating that many valuable relationships with merchants or consumers. So I feel like those smaller players are at a significantly higher risk than some of those bigger players.
Nice, Chris. One of the great things about Afterpay in particular, and the rest of the sector in general, is, as I said, Flexi Group, now called Humm, had a product out there. Laybuy had already existed. Credit cards already existed. To some degree, Afterpay is a finance company, but it's entirely a finance company. On the flip side, though, what it brought to the market was a new way of paying, a new way of being paid for the category. So think about, again, you could have flexi grouped everything, but no one called it flexi grouping because it wasn't really a thing. Flexi renting, maybe. But after it became cool, it became trendy, it became kind of fun and interesting. It's a business that in the past, the big banks probably didn't want to, couldn't do. But I'm curious as you think through what buy now, pay later looks like into the future, what happens as the big guys get more involved? We've got PayPal, Apple Pay, Citi, Goldman Sachs with Apple. There's, the heavyweights were probably late to the party, but they're still heavyweights. And when they turn up, they're going to throw their weight around, aren't they?
Yeah, well, that's the concern when it goes into these bigger businesses, that it becomes more of a feature rather than a product in itself. And when that happens, often that they charge a lot lower fees towards the merchants to be able to do this. And that's one of the key concerns for the industry is there's a lot of these businesses, you look at their, I guess, their revenue take relative to total transaction values, and it's quite high. And a lot of these businesses, your PayPals, for example, are a lot lower, for example. So it is a concern for a lot of these smaller companies that eventually down the track, as the industry becomes a little more consolidated and more companies just are expected to have that buy now, pay later offering, that the price for the merchant is going to be something that will be considered as well. So that is certainly something to consider when investing in the smaller end of this space.
And KJ, take us out a bit further there on Chris's line of thinking. The product versus the feature thing is something I've been worried about for a long time. And frankly, while I've been worried about it, Afterpay share price went from 8 to 120, so more fool me. And yet, I still look at this sector and think, why aren't the banks just offering these as standard transaction accounts? Why aren't the credit card companies saying, we'll just lengthen the credit period? You don't really need this extra middleman in between. The merchants who are paying 3, 4, 5, 6%, I'm sure, would much rather pay 2% to Visa and have Visa swallow the cost of just simply keeping those customers. The same with the banks on the other side. Just play through the feature and product conversation for me. If I look out 5 and 10 years, do I still feel good about owning some of these buy now, pay later players? Have they already themselves morphed at that point, become part of bigger businesses? How do you think about the product feature trade-off as we go into the future?
Yeah, it's an interesting one. And I think it's quite hard. It's been quite hard for the incumbents to actually pivot towards this early on, because the way the sort of disruption works is that in the beginning, these companies look like pretenders, and the incumbents don't really feel threatened by them.
That's right.
And in a sense, for the incumbents to copy the business model, you're kind of cannibalizing your existing product and your existing offerings. So you try not to venture there. And then it's also hard for large established companies to stop doing what's working and try do something else. And so that kind of explains how far they've come along. But I think now that companies like Afterpay, like Zip, and the rest of them have proven that the business model, there is a business model there, and have proven that this is what their consumers want. I think when you see companies as large as PayPal and as large as Square coming into the space, spending $40 billion or $30 billion to acquire Afterpay, it does signal that they do feel that there's plenty of offering there or value there for them. I do think that if you look at the rationale being given for especially for the Afterpay acquisition, it's less about Afterpay as a standalone business, but more about what Afterpay can contribute to Square's existing ecosystem. We know that Square has ecosystems with their Cash App product, and then also the seller ecosystem that they offer with their Square dongle for payments. And so they really look at it that the value that they can offer by plugging in Afterpay into those ecosystems can really enhance the offering for that. So that suggests to me that the industry is actually moving towards that feature aspect and rather than standalone product. Also, traditionally, as you've been talking about, this type of offering has been within like credit card companies or within the bank. So again, it's more of a long-lasting feature. I mean, the last thing as well is that when you look at the growth rates of these companies, they suggest that the industry as a whole is still in its early stages. And so we're not yet at that maturity. But I think that as time progresses, what may happen is that growth rates may slow down as more of the initial early wins are won, and then it's get harder and harder to just win more customers. And then as new competitors come into the space, margins may actually be challenged because they may start offering more promotional offers or more competitive offers just to try and compete. And then when margins do get squeezed, we know that these companies actually aren't profitable as yet. They're trying to get scale and then hopefully become profitable with scale. I think that's where it really becomes interesting. If you're not partnered up with a more, cashed up large player, or if you're not part of a feature of a larger offering, then as a standalone company, it may become quite hard to continue to do that. And so some of these companies may actually come back to the market to raise more capital to continue to spend and invest. So I think overall, my personal view is that eventually we will see some of these, essentially the buy now, pay later offering becoming more of a feature. And I think it becomes a valuable feature for companies with large ecosystems like PayPal and like Square. And I think as standalone businesses, it may become harder and harder for them to justify that.
Beautiful. Thanks, KG. Yeah, it reminds me a little bit of the Blockbuster Netflix story, right? When you circle the wagons and try and protect your own business your competitors sometimes get straight past you. And you think about, even to the extent that Square is the purchaser of Afterpay rather than one of the major banks here or overseas, there is still a sense that the big banks are still saying, even now, we'll be right, it'll go away, don't worry about it. And you do wonder whether they end up being a version, probably not going to be destroyed like Blockbuster Video was, but when the video rental stores decided they wanted to do that rather than embrace this streaming, even DVD by mail as it originally started Netflix, that whole idea, it's fine while it's fine. And eventually when the castle wall crumbles, there's not much left to be saved. And that certainly was a story. Compare that to, say, Amazon. I own shares of Amazon. When Jeff Bezos literally set the Kindle term across the other side of the country and said, don't be distracted by these guys trying to protect the physical book business. It'll be what it'll be. We'll deal with whatever comes from it, but go and build us the best business possible. It's a really challenging thing to deal with innovation. You want to protect your margins. You want to hope the competitor goes away, the innovator. Sometimes they do. and so you successfully defend. Other times you get overrun, and before you know it, your blockbuster video. So guys, that was great. Thank you for the summary of some of the risks in the sector more broadly. I think the really important thing we always try and do is present both sides of the argument, or at least when we do present a positive case, also try and give you the reasons why you should either be careful of an investment, why you should look out for things that may go wrong, or frankly, why diversification is just important. So thanks for doing that, guys. I got you guys to huddle together, a little bit of a peek behind the curtain, and find me the 3 ASX listed buy now, pay later players that you guys as a group, and probably the Motley Fool as a business in our different services, like more than the others. Be prepared to say, you know what, I think these ones of all of them have the best chance of success. Ryan, I'll start with you. What was one of the companies we came up with as the buy now, pay later player, maybe that people should buy or at least consider buying if they want some exposure in this sector?
Look, I think when it comes to these sort of businesses and industries, it's hard to look past the biggest player, the first mover, and the dominant player in the industry. So I'm going to say Afterpay. Now there are a couple of caveats here. Things have changed dramatically in the past few weeks. Yes. So the risk profile of the entire industry completely changed. Right. I think when PayPal and Apple both said that they were, looking at expanding. Well, PayPal did, and then Apple rumored to be expanding into buy now, pay later in Australia, or particularly in America for Apple's case. So that sort of changed the risk dynamics once. I think the risk dynamics did change again when Square made its move, and now there is talk that I have heard rumors, so I won't mention names because they're only very small rumors at the minute, but murmurings that other buy now, pay later operators, not necessarily in Australia, but internationally owned or internationally operated ones, may also be under the radar of other rival businesses. Mm-hmm. Now, if that becomes a trend and those bigger players are taken out of the market and turned into features of bigger, more diverse payment businesses, mm-hmm. then I think that is a bigger risk for the buy now, pay later operators on their own. So with that being the caveat, I think Afterpay would be a riskier option if that were to continue and Afterpay were to continue as a standalone business. That said, as Kevin said a minute ago, that Afterpay wasn't necessarily being purchased by Square for what Afterpay has to offer, but for what Afterpay has to offer Square's business I guess, link its two ecosystems. Yeah. I really like that aspect. And I think that the Afterpay brand the Afterpay product could bring a lot of benefits to Square. Mm. The fact that Square shares are expected to also trade on the ASX post assuming a successful acquisition, then I like the Afterpay that could turn into a Square. So I still like Afterpay as a brand. There are risks associated with it, particularly if the acquisition doesn't go through. Yeah. But on the caveat that it does, then I like it.
I like that, mate. So yeah, I think you're right. There's probably not many businesses that could have paid the amount Square has paid. At least they could have literally afforded the money, but justifying the price because of the ability of Square to wring value out of that straight away in a way that a financial buyer like you or I, should we have a spare, $39 billion or so, but even another player who's going to run it as a standalone business is simply more valuable inside Square than outside Square. So I like that. And by definition, I think what I'm hearing you say is not only is Afterpay the first mover and the leader, it's also when it becomes part of Square, more diversified, so lower risk, and you actually quite like the Square business itself. Is that? I don't want to paraphrase or put words in your mouth, but is that pretty close?
Yeah, no, look, that's spot on. So Square has two relatively separate ecosystems, one with the Square payments terminals and then one with the Cash App. Mm-hmm. The idea of acquiring Afterpay is really to link those two together. It will sort of act as the bridge, help with, I guess, user engagement as one, and also merchant engagement too. So there are some real benefits to be taken from this acquisition.
There you go. Afterpay is our first one. I'll go to you, Kevin, for another one. We've got 3. This is the second of 3. What's the second business that we think investors should consider buying?
Yeah, so I'll go with Zip. A couple of reasons why I'll go with Zip. I mean, the first one there is you've got a founder CEO there who's got a significant ownership stake in the business. He's been running it for a while. That's Larry Diamond. He owns roughly over 9% of the business, so a decent form of skin in the game there. And he has that experience and track record of running this business. So it's not new on the scene. There is a bit of track record that you can see there. The other thing is, short of Afterpay, it does have the next level of scale. So it is a bit more established. Right now, when you look at some of the metrics, I mean, it's got over 7 million customers, 4.4 million of them in the US. So that is sizable, and it's still growing as well. Revenue as well, most recent results, quarterly results, revenue was up over 100% in total. And in the US, revenue was up 280%. So while it's relatively more established than its younger players, it's not a slouch either. It's actually still pretty growing at a significant pace. I think with these buy now, pay later companies, what you really want to see is strong growth, because the reality is that the business model still needs to be proven out. When we look at the unit economics, we do think it can be profitable at scale, but they're actually not profitable right now. So you want a company that can get to a decent level of scale quick enough. So going with a company like Zip that does have that decent payment volumes, transaction volumes, and in the last quarter was almost $1.8 billion. And when you look at the margins as well, their take rate, so revenue as a percentage of the overall payment volumes, was just over 7%. So that's pretty healthy and pretty high. I think that could come down over time with competition, but still pretty high. And they do have that geographical expansion strategy and different types of products as well. So I think if you can find a company like Zip or like Afterpay, but in this case, I'm going with Zip, a company that can really get to scale quick enough with decent take rates, that as long as that growth rate is still pretty strong and robust, then that's pretty good. So I'll go with Zip.
Beautiful. I like that, mate. It's hard to beat sheer growth, right? I mean, it's not profitable yet. Profitability may be a long way away, may never happen in the worst case scenario. But when you're growing at those sort of rates, it really does give you much more control over your future than a business, and even a profitable business that is not growing or potentially going backwards. You simply just have so much scale, so much potential, so much momentum. They're hard businesses to avoid. Chris, let's go to last but not least. You're one of the three that we've just elected to talk about and to recommend our viewers consider purchasing. This one I think is not in the top echelon, but one that you think might actually be maybe the underdog, maybe the smoky, the one that comes around the outside of the pack, outside of the field at the end of the Melbourne Cup. You're going with a smaller player.
Yeah. This is certainly one for the investors looking for the higher risk, higher reward companies at the smaller end of town. So it's Laybuy. So Laybuy, despite posting some very strong growth figures over the past few years, figures that are actually quite comparable to the likes of the bigger buy now, pay later companies, it actually has the lowest valuation of all the pure play buy now, pay later providers on the list. But more importantly, that there are a few things on the business's radar that might actually support an acceleration in growth in the near future. So firstly, it has recently announced a strategic partnership in the UK, which will see the business access more than 5,000 merchants, including some larger brands such as Nike, Amazon, and eBay, and it will allow the customers to use the Laybuy app to purchase with these merchants without the need for merchant integration or direct relationships with these businesses. So this will be done for an affiliate network, which is essentially an intermediary between the merchants and Laybuy. So this isn't quite as ideal as building out these direct relationships, as it will likely come with lower merchant fee rates, but it is a good way to quickly increase the value of your offering for customers as you can now use the product in more places. Also, the business's tap to pay offering, which I mentioned when I was discussing the business earlier, was only just launched in the UK in June, and it could also help reduce the friction for customers and potentially help with growth rates in the region as well. So the company now also has a reasonable balance sheet after recent capital raising, and as I mentioned before, this business is trading at less than 4 times sales, and it expects revenue to nearly double again this financial year. So it's not a massive price to pay. So it's an interesting business. But yeah, being a smaller provider does mean that it comes with a lot of risk. So risk such as competition. So we mentioned PayPal, we mentioned Apple, and Ryan also quickly mentioned before, there are a lot of new competitors coming into the space. In fact, Citibank, as he mentioned, just announced yesterday that's introducing a buy now, pay later product. It almost feels like every day there's a new offering coming into the market, and so I'm sure more will follow. So yeah, there are some really strong advantages to investing in the first mover or the leader in the space. But yeah, for individuals who are looking for higher risk, higher reward opportunities, I think Laybuy is an attractive investment to look at.
There we go. So the 3 companies we think are worth your time to research and maybe consider buying are Afterpay, the code is APT, Zip, the code is Z1P, and Laybuy is LBY. I think, am I right there, Chris?
Yeah, that's right.
There you go. So not bad memory for an old bloke, am I? Guys, thank you very much. Viewers, fellow fools, I hope you've enjoyed hearing from Kevin, Ryan, and Chris. They've done a heap of work to prepare this for you. I'm sure you can see and hear that in the work that they've done. 10 Australian companies, probably another half a dozen international businesses the guys have digested to come up with some great ideas and some great information, even for those that we didn't suggest you buy. Hopefully you now know a lot more about the sector, a lot more about the companies that we included, and a lot more about those 3 we think are very worth your consideration. Thank you for watching with your members or your viewers on YouTube. We thank you for spending a little bit of time with us. It's been a long video, but one that I think is heaps, chock full of heaps of information. I hope you've absolutely enjoyed it. Gentlemen, thank you for your contributions. I really appreciate you taking the time, as I'm sure our viewers do. Until our next video, make sure you do join us on our YouTube channel, by the way, Motley Fool Australia. Full on.